Kelly Holder here with Weikert Realtors, The Space Place. Today I'm going to talk about some of the cost involved in buying a home. If you've never purchased a home before, knowing what to budget for may feel intimidating, but it doesn't have to. By understanding the costs that you may have to encounter up front, you can take control of the process and you'll be prepared. First, before money talk, let's discuss the power of a pre-approval. You don't have to have a house picked out in order to get pre-approved for a home loan. And in fact, I would recommend that speaking to a lender and acquiring a pre-approval come before even going to look at a home. Here are some reasons why you should get pre-approved. Your offer is stronger than another buyer who may only have a pre-qualification. What's the difference, you may ask? A pre-qualification is quick and less detailed and can help you estimate how much you can borrow for a car or home. Pre-approvals are more detailed and can take a little bit longer, but can help you shop for a home with confidence. It can also help you prove to a seller that you're able to receive financing. Other reasons to get pre-approved are that, number one, it shows sellers that you're motivated to buy a home. It can save time by letting you know how much you can comfortably afford and which programs you may qualify for. It makes the process go smooth. Your contract may move faster through the loan process, and it increases your credibility as a buyer. And there are no surprises. Once you're pre-approved, your lender will provide you with a letter to submit with your offer. All offers should be submitted with a pre-approval. Now for the money talk, the down payment. So saving for your down payment is likely top of mind. How much do you really need? A common misconception is that you have to put down 20% of the purchase price, but that's not necessarily the case. Unless it's specified by your loan type or lender, you don't have to. Here are some home loan options that require as little as 3.5% or even 0% down. So typically, conventional loans require a minimum of 5%. An FHA loan would require 3.5%, and a VA loan would require no down payment. Another type of FHA loan is called a USDA loan. Those home loans are particularly favorable to those living in rural or low-income areas. They offer zero money down and lenient eligibility requirements and competitive interest rates due to the loan being guaranteed by the USDA. Your lender will discuss these type of loan types and decide which loan will work best for your situation. Now, if you're purchasing a $300,000 home, you would take $300,000 times your percentage of down payment required. So for example, using a conventional loan, it would be $3,000 times 5% or 0.05, which is $15,000. $300,000 times 3.5% is going to be $10,500. And of course, putting more money into your down payment will reduce your monthly payment. Now let's talk about earnest money. Earnest money is referred to as good faith money. In other words, it's a payment made by the buyer at the time of offer to purchase. At the time of offer to purchase is written and demonstrates to the seller that they fully intend to close on the sale of the property. The buyer is saying, I'm really interested, and if I change my mind and decide not to close on this transaction for any reason other than certain contingencies specified within the purchase agreement, I understand that I'm going to forfeit my earnest money. We typically see buyers put down 1% of the purchase price towards earnest money, but sometimes not even that much. For example, let's say you want to put an offer down on a $300,000 house. You would calculate 1% of that, which would be $3,000. This is the earnest money amount that you could use as part of your offer. You, the buyer, will need to determine an amount that not only shows your interest, but works for you in a financial standpoint as well. Please note that your earnest money will be going towards your closing costs, so it does credit back to you at the end. Once your offer has been accepted, you will have a due diligence period or inspection period. During this time, we highly recommend you get a general home inspection done because in Alabama, it's the buyer's responsibility to discover any deficiencies in the home. Home inspections are often priced by the size of the home, but you can expect the cost to be around $400, give or take. Once you've gotten through the inspection period and repairs have been negotiated, your lender is going to require an appraisal to be done on the home. They want to ensure that the home is worth what you've offered to pay. The cost is often between $400 and $700, and depending on your lender, you may pay it out of pocket before the home closes, or your lender may just add it into your closing costs to be paid at the time of closing. Before we discuss those closing costs, let's discuss an optional cost for you, purchasing a home warranty. This is not required, but it may be a good idea, especially if your home is older and you might be anticipating some things going wrong in the near future. Home warranties can be great. I know they've personally saved me when I was renting out my personal house in Texas. That warranty covered everything that my renters needed fixed. However, with any insurance, there's always going to be fine print. So you'd want to read over the contract before purchasing home warranties. They can cost anywhere from $500 to $800 per year, depending on the warranty. All right, so the final out-of-pocket closing costs are out-of-pocket costs you'll need to budget for are the closing costs, which will be due at the day of closing. These closing costs typically include the loan origination fees, appraisal fees, title search fees, the title insurance, property taxes, homeowners insurance, essentially all the fees associated with processing and finalizing the real estate transaction beyond the property's purchase price itself. So some key points about closing costs. Let's talk about what is the loan origination fee. This is a fee charged by the lender for processing the mortgage loan application. The appraisal fee is the cost to have a professional assess the property's market value. The title search and title insurance are fees to verify the property's ownership history and protect against title issues for the buyer. Property taxes, usually a portion of the property taxes are paid up front at closing, and homeowners insurance, typically they'll ask for the first year up front to be included in those closing costs. They can be quite expensive. In fact, they're typically 2 to 5% of the cost of the home. That's why it's important that you discuss this with your lender and plan for those costs. One final possible cost, and as you plan ahead for the closing day, be sure to budget for your real estate agent's professional service fee as well, in case the seller doesn't cover it. But don't worry, you'll work with your agent ahead of time to agree on what this fee is, so you won't be surprised at the finish line. And your agent will likely negotiate that into the offer and ask the seller to contribute closing costs to cover that fee for you. So the bottom line here is that the key to a successful home buying saving strategy is being informed about what you need to save for. Because when you understand what to expect, you can plan ahead. With any expert agent and a trusted lender, you're going to have the information you need to move forward with confidence. I'm Kelly Holder, and I'd be happy to help you on your buying journey. My contact information is at the end. Thanks, and have a great day.